The fixed income asset class is made up of several different components, one of them being high-grade bonds. With me today is Paul Chin from Jamieson Coote Bonds to tell us how high-grade bonds can play a part in investors' portfolios. Welcome, Paul.
Thanks, Darren, for having me today.
Look, we might start by painting some context around where the markets are at the moment. So navigating investment markets hasn't been easy in the recent past. Where do you see them headed now?
I've got to tell you, Darren, look, in recent years, we've seen markets really conditioned to expect high returns and low volatility for typical or traditional asset classes. And that's a real concern on a going forward basis because we've got an issue around markets and we've got an issue around economics, and the fact that these sorts of characteristics can't really levitate above gravity. My concern is that there's complacency around pricing of risk around markets, and furthermore, when you think about what JCB does as part of its investment process, we oversee or look at over 400 indicators as part of trying to get a health of markets and economics. It's telling us that we are deep late cycle. When you consider the tight credit spreads and how that's been falling in recent years, when you think about the high valuations and low volatility of these traditional asset classes, think domestic and international equities, infrastructure and property. And when you think also about the fact that central banks right around the world are thinking about raising rates, these are going to be impactful when you consider how much debt has been overloaded across the economy since the global financial crisis. The debt levels are enormous right across developed and emerging markets, public and private sectors. So the fact that a potentially rising rate environment is in place could materially impact markets right there.
With all that in mind, can you give us a little bit of an insight into what you're seeing about portfolio construction attitudes amongst investors right now?
Yeah, Darren, I'm fortunate to sit with several investment committees and deal a lot with clients across the Australian landscape. And I'm broadly seeing two groups emerge. I think the first group think a lot about how to eke out returns and eke out yield in this late cycle environment. What's their behaviour? Well, they're overweighting, deliberately or otherwise, into risky assets. They're overweighting into credit. And so they're taking significant bets thinking that they can exit at precisely the right moment if they believe that we are truly late cycle. There's a second group of investors there, Darren, and that relates to the folks who are thinking a lot more about defence, given where we are in the cycle. And that is, they're thinking a lot more about principle and income stability. They're thinking about trying to secure assets which have high liquidity during times of stress. And then they're thinking about trying to get assets which can truly diversify against your growth and risky assets, again, during stressful periods. And we think it's really hard to find those sorts of asset classes which are inexpensive, which can perform that role over different sorts of market cycles. So in short, I'm seeing either that sort of complacency or that sort of seeking defence. But either way, I do believe that it's important to have defence in your portfolios to protect against any kind of late cycle hiccups that we have along the way.
Okay, now Jamieson Coote Bonds specialise in high-grade bonds. Can you tell us a little bit about what the definition of high-grade bonds are and what sort of role can they play in a portfolio?
So high-grade bonds are interesting, and just extending that thought, Darren, when I have a look at the typical sort of holding in Australian investors' portfolios, it tends to be dominated by one of five or a combination of five sorts of assets. Think cash and term deposits, which are government guaranteed up to $250,000. Think in terms of hybrids, which tend to be issued by Big Four banks or financial institutions. Credit is another sort of instrument which is quite popular, again dominated by financial services. Negatively geared property. Surprise, surprise, this is also backed by Big Four banks and Big Four bank equity. So each of these five sorts of instruments are interesting because I've seen investors use that as a type of proxy for defence. My concern around that is that these instruments can actually represent one particular risk, and that is financial risk. High grade debt plays a different role because its risk comes from a different source. It's explicitly backed by the government. So when we think about government, semi-government and supranationals, each one of these are backed by the highest quality of issues and therefore perform differently relative to that other risk stack that I just talked about. So the key message is that high grade bonds have a real role to play in portfolios in kind of complementing what's so commonplace in people's portfolios.
Investors are forever looking at performance though, Paul, so what sort of performance can they expect from high grade bonds?
Yeah, look, Darren, I think you should be trying to right-size your expectations around high-grade bonds of all your asset classes as well. But in high-grade bonds, right-sizing your expectations over the right sort of time horizon as well. You shouldn't be thinking about short-term and fluctuations and the like. You should be thinking about positioning your portfolio for defence and over extended periods. I would note a couple of things. I think the first thing is that high-grade bonds are much more muted in terms of returns relative to your risky assets. So our study of calendar year returns all the way back to the 1990s tells us that high-grade bonds have only been down 3 times over those 26 years. In contrast, Australian equities has been down over 6 times, and when they've been down, as we know, global financial crisis, dot-com bubble, in the neighbourhood of 40% down. So high-grade bonds can act as a kind of ballast or zig when your risky assets are zagging and protect on that downside and provide far more muted sort of returns. I would highlight one other point, Darren, and I think that is that the real concern about a potential rising rate environment, that's actually not a bad news story for high-grade bonds. Well, why is that? Because as yields increase, then you've got maturing bonds which need to be reinvested into the prevailing yield, and coupons also needing to be reinvested into the maturing yield. That's a good news story, and studies done by Bank of America Merrill Lynch tell us that over time, over an extended period, you actually have a self-rebalancing mechanism within high-grade bonds, which allows you to appreciate some really strong returns over extended periods. That's not apparent in credit, and that's not apparent in equities during times of stress.
Now, Paul, you just participated on an Undiscovered Manager Showcase, which was hosted by Financial Observer and Evergreen. In which case, can you just fill us in a little bit about Jamieson Coote Bonds, because obviously they fit into that Undiscovered Manager category. So just tell us a little bit about the manager.
Yeah, so JCB is an emerging manager, as you say. We're a duration management specialist with security selection expertise in high-grade space. So we want to defend and protect for our investors. The fund or the business was founded by Charlie Jamieson and Angus Coote in 2014, and they are long-time industry stalwarts in capital markets. And they saw an opportunity to protect and defend, or more particularly deliver a product which was truly defensive, which didn't have any sort of sophisticated or risky exposures in there. None of these sophisticated or risky sorts of investment strategies, and in other words, is quite plain vanilla. The business since 2014, is now coming up to its 3-year track record in December, and has enjoyed some really good momentum. In fact, we're fortunate to manage over $500 million in assets, so we're entrusted to manage those assets on behalf of individuals, advisors, wealth managers, and more recently institutions as well. Finally, Darren, we're backed by a really strong, stellar advisory board who help navigate both in an investment and commercial sense, chaired by the former Future Fund CEO and President Mark Burgess and noted economist Saul Lestlake.
You just mentioned that Jamieson Coote Bonds is a specialist duration manager. What sort of difference does that make? And how do you generate performance?
Yeah, so we specialise in duration management. So we evaluate the economy and markets. We think a lot about monetary policy and political policy as well, and we also think about supply and flows. So these are three unique inputs into evaluating the impact on the overall yield curve. The second point to note is we've got four principals who have all spent the vast majority of their careers offshore: UK, US, Europe, and Asia. And so we all have managed money during rising rates, falling rates, planes crashing into buildings, natural disasters. So we're well seasoned campaigners along the way. The third thing is that we've got some strong sort of investment strategies which are repeatable and scalable, but above all build on our heritage as risk managers first and foremost. And so that is a key tenet of the way we manage money in terms of protecting on the downside and participating on the upside.
Okay, you mentioned 2014 and the last 3 years. How's your performance been?
So performance has been good for our investors. So since inception, we've managed to deliver alpha in excess of 1.35% per annum. And again, that's coming into our 3-year number. But Darren, this is more than just an alpha generating story. As I said, this is protection and defence. And so, in 13 down months, we've outperformed 12 of those 13 down months, which is a good news story. We've managed to deliver a lower market beta relative to index of around about 75% of index, and the volatility levels have been in that same kind of neighbourhood as well. So if you're looking for defence, if you're thinking about truly protecting on the downside and diversifying against your growth and risky assets, then that's where it can play a strong role. I think the other point I'd make, Darren, is that relative to cash and term deposits, the market beta itself has outperformed those two sorts of common or liquid sort of instruments. And so the thing to note out of that is that this exposure from JCB can outperform cash term deposits, act as a good sort of alternative to that sort of exposure. And then also have an alpha generating opportunity while protecting on the downside. And I think that's a good news story for investors if you are thinking about true defence and trying to secure something to provide ballast for your portfolios.
Okay, Paul, thank you very much for your time today.
Thank you, Darren.